Brad Williams, Frugal Finance, bull versus bear markets, understanding the difference. The terms bull and bear markets are commonly used to describe the overall state of stock markets, but the factors influencing these markets trends are quite complex. What are bull and bear markets? In finance, a bull market refers to a period in which stock prices are rising or expected to rise, while a bear market indicates a period where stock prices are falling or expected to fall. These trends significantly impact investors' behavior and market performance, so it's essential for investors to comprehend the implications of each market condition. Key points to consider: bull market, a market where stock prices are rising, reflecting a general strong economy with rising investor confidence. Bear market, a market marked by declining stock prices, often tied to slowing economy and pessimistic investor sentiment. Investor sentiment: most investors tend to be optimistic, driving the market higher during a bull market. Conversely, during a bear market, negative sentiment often leads to selling pressure. Bear market risks: bear markets are more challenging for investors as stocks lose value and market volatility increases. Timing the reversal of a bear market is difficult, often causing investors to pull back and hold cash, which can further drive prices down. What is a bull market? A bull market signifies a period of sustained growth in the economy with an increase in stock prices. During this time, investors typically feel optimistic about future economic conditions, believing that the upward trend in prices will continue. These markets are often characterized by rising levels of employment and consumer spending, which help drive the economy forward. What is a bear market? A bear market occurs when stock prices fall by 20% or more from their recent highs. In these conditions, investor sentiment turns negative, which further drives the market down. Bear markets are often accompanied by economic downturns, leading to slower business growth and higher unemployment rates as companies cut costs and reduce their workforce. Key characteristics of bull versus bear markets: supply and demand. In a bull market, demand for securities exceeds supply, causing prices to rise. In contrast, during a bear market, supply outpaces demand, leading to falling prices. Investor psychology: investor behavior greatly influences market conditions. In a bull market, optimism prevails, prompting more investment. In a bear market, pessimism drives investors to pull back and invest in safer assets such as bonds. Economic activity: bull markets often align with robust economic conditions where businesses are thriving and consumer spending is high. Bear markets, however, coincide with economic slowdowns where businesses may struggle to maintain profits due to reduced consumer spending. Tracking market trends: the primary determinant of a bull or bear market is its long-term performance, not short-term fluctuations. While small market movements may indicate temporary corrections, identifying a true bull or bear market requires analyzing sustained trend over an extended period. Occasionally, markets may stagnate, showing both upward and downward movements, which result in a neutral or flat trend. What should you do in each market? Bull market. In a bull market, investors typically seek to capitalize on rising stock prices by buying early in the trend and selling when prices peak. Since losses are generally minor during these times, investors often feel more confident making purchases. Bear market. During a bear market, the risk of loss is higher as prices continue to decline. Investors may consider safer options like bonds or defensive stocks, industries that remain stable despite economic conditions, such as utilities. Some might also opt to short sell, betting on future price declines. Can buying in a bear market be beneficial? It's possible to make profitable investments during a bear market by buying undervalued stocks, but this comes with risks. Prices may continue to fall, and some companies may go bankrupt. Careful research into companies with strong fundamentals can provide potential opportunities for significant returns when the market eventually recovers. Origins of the term bull and bear. The terms bull and bear are believed to originate from the animal's behavior. Bulls attack by charging upwards, symbolizing a market that is rising, while bears swipe downward, representing a market in decline. Which markets last longer, bull or bear? Historically, bull markets last longer than bear markets. Since 1942, the average bull market has lasted about 4.2 years, while bear markets typically last only 11.1 months. The average return of bull markets has been significantly higher than the losses in bear markets. Conclusion: understanding whether the market is in a bull or bear phase can help guide investment decisions. While both types of markets come with unique opportunities and risks, the long-term trend of the stock market has historically been upward. As such, it's essential to stay informed and adjust your investment strategies to align with current market conditions. If you have any questions or concerns about bull versus bear markets, comment. Brad Williams, Frugal Finance. Thanks for watching. Hope that helps. See you soon.